check with Evan Lucas, his Chief Market Strategist at InvestSMART. Before we talk about more important issues, Evan, do you know Tones and I?
I know of her.
Yeah.
I have certainly, like Laura just said, I've heard her. If you had pointed her out to me, I'd be like, oh, okay.
Yeah, okay. Oh, that's it. Okay, let's
You're an expert on other things.
Let's talk the economy at the moment, Evan. A complete earthquake that took place this week at Westpac. Just first of all, your thoughts on what's happened and the ramifications of that.
Yeah, look, my take on it is that I don't think this is the end of with regards to particularly the clean out. I think if you listen to what is coming out from the big investors inside of this, they are going to get a strike on December 12th when they have their AGM. That's pretty clear. And I think you can also hear growing, particularly from the industry super funds, growing unrest around their head of compliance. Also, you'd have to look at some of the other parts of the board that have been there for over 10 years that probably need to be considering their idea of re-election. So that's part of it. I think the other side of it is what our world still can't quantify yet is what the size of the fine will be. And that is, I think, what's the bigger part of this is it probably and realistically should be north of $1 billion, considering that $700 million was done at CBA. The question that comes with that is whether or not Westpac has to actually come to the market and raise capital to cover all of their other requirements under APRA to have a certain amount of cash on balance sheet, because $1 billion even for a Westpac is a heck of a lot of money to have to give out as a fine. So that's why next year will be very interesting. And the thing that sort of took me by interest to have a look at all this is that 2019 has been an astounding year for equity. So until this all happened, Westpac was up 19.5%. It's now down 20 since it happened. And that therefore means that all of 2019 gains are gone. And that shows that Westpac, not only is it severely underperforming its three other peers, it's now severely underperforming the market. And that is also somewhere you don't want to be in our world, is having being a laggard and possibly, quite a disappointing discount stock for quite a period to come.
Looking at the ASX yesterday, I mean, that was good news.
Yeah.
Today, we're probably going to open strongly as well, but we know how the share market goes, up and down, like a roller coaster. But this week we heard from the RBA governor talking about 2 rate cuts. It's not going to go below 0.25%. If it gets to that point, he'll then look at what is known as unconventional monetary policy, like quantitative easing. How significant was that?
Huge. And well, look, I'll quickly say something there. In terms of your point about roller coaster, I'll take you up on that one day.
Okay.
But the reason I say it's absolutely huge is that part of the theoretical sort of movements that have been going on in markets basically since the GFC is that everybody talks about property prices and what's happened with property prices from interest rate cuts in Australia, and it's not just here, globally, and how much of a supporter monetary policy has been to assets. The thing that's probably missed is that it's as big, if not more of a supporter in equities. And that's the other side of this, is that the reason I answered the question around, the market this year having such a good year, we've had 3 rate cuts this year. And it's even more telling that as of yesterday, markets globally were pretty flat. We jumped up almost 1%. And that is off the back of what basically Philip Lowe is telling you and putting out a roadmap for 2020, 2021 about what could possibly happen towards, as you said, quantitative easing. Everybody had been speculating that maybe it was 0.5 of 1% was where he was going to probably get to and then start. It's now obviously 0.25. So there are 2 rate cuts coming before this happened. And yesterday, economists everywhere were getting, the pen out and basically writing that in. The probability of having a cash rate of 2.5 of 1% by this time next year jumped to 43% off the back of all of this. So that means that you are now having the idea that it's going to happen. QE is still basically seen by economists as the base case because employment is starting to slow down, consumption is starting to get a little bit lag. We know also already that basically business confidence and business conditions have been at lows that we haven't seen for 10 to 15 years. So there's a lot of work to be done in terms of that there. So that's why yesterday the market reacted to all this, that they believe that in 2020, and they try and price 12 months ahead, that the cash rate will be another 50 basis points lower than where we currently are. And that therefore is an asset inflator and why the market's jumping up.
Okay, there we go. Evan Lucas, as always, appreciate your time. Thanks for joining us. We'll chat to you again next week.
Thanks, guys.